Welcome to the HC Commodities Podcast, a podcast dedicated to the commodities sector and the people within it. I'm your host, Paul Chapman. This podcast is produced by HC Group, a global search firm dedicated to the commodities sector. On February 6th of this year, I was asked by Argus to sit on the other side of the table at the Argus Global Crude Summit here in Houston. Our panel was moderated by Matthew Oatway, Executive Vice President North America for Argus, and we discussed the shifting landscape of crude oil trading, growth of AI, the rise of options, and new entrants from hedge funds to asset-backed organizations. Alongside me was Peter Keavey, Managing Director and Global Head of Energy and Environmental Products at the CME Group. I should note that Peter and Matthew's views are their own and do not necessarily express that of their organization. Mine do. And if you have any questions about what we discussed in terms of HC services around helping organizations grow teams, or information about compensation regimes and organizational structure that our talent intelligence team provides, or indeed about Enco Insights, our expert network that provides experts for advisory work in and around energy and commodities trading, please do reach out, and I'll put links in the show notes. Very grateful to Argus for the invitation. It was an excellent event and well attended. And as always, please do leave us a positive review on the platform you're listening on. And as always, I hope you enjoy the episode.
We're here to talk about fundamental changes in, how the markets are being structured, how companies are deploying different trading strategies, looking at different risk management strategies, looking at how market participant mix is changing in these markets, and really how, participants in these markets are redesigning their operations and risk management activities. So we're really lucky to have Pete and Paul here today. I think maybe just to start, could you both introduce yourselves? Maybe Pete, starting with you.
Sure. Thank you, Matt. And thanks, Argus, for having me here today. So I am the global head. I'm a managing director and global head of energy at CME Group. I've been in the industry for 35 years. My background personally is in natural gas trading prior to the exchange. But I have a deep interest in crude oil as well. I've traded crude for several years. And I manage our product slate and all of our customer relationships.
Thanks, Matt, and thanks for inviting us. So my name is Paul Chapman. I'm host of the HC Commodities Podcast. I'm managing partner of HC Group. A little bit of a different background, I imagine, for this kind of panel, but HC Group is a global search firm dedicated to energy and commodities with 20 years experience or 20 years heritage and offices around the world. So I guess talking very much from the people landscape and the participants and the changes that we've seen over time.
So I think maybe we'll just start from the very high level. It's been 15 years since the U.S. exited the Great Recession. It's been 10 years since the export ban was lifted. How has the crude oil trading landscape changed in that time? Maybe Paul, starting with you.
Yeah, I think to take a step back, if you go back 15 years, from a standpoint of who was trading crude, the participants, there's been a dramatic change compared to today, right? 15 years ago you had, and don't quote me on the numbers, but you had 8 significant trading capabilities, banks trading with trading platforms. You had a slew of small trading houses. You had utilities, merchants, and every oil major and even some producers had trading platforms of significant size. And then we have financial crisis, you have Dodd-Frank, and you effectively have the end of the super cycle, China buying and so forth, that meant suddenly by 2014, 2015, most of those banks had exited or at least significantly scaled down their trading and risk management capabilities. The same is true of the oil majors, with one or two exceptions. Most of the utilities have gotten out, and you just see a huge consolidation of what was left. So you come into 2018 when volatility returns with far fewer seats trading crude or the risk management, the associated disciplines, far fewer organizations. And that kind of sets up some of the challenges that we face today in the return of volatility and, I think being driven by deglobalization, sanctions, etc., but particularly by the energy transition. So, it's been a really volatile time to be a crude trader around the world, and not least here in Houston.
So, I mean, I've worked at 2 different investment banks, 2 trade houses, a gas pipeline trading company, and also a hedge fund. So I've seen it. I think I've done every job in the industry at this point. The way I think about this and the way I've observed it, both as a trader, manager, and now at the exchange, is, you can think about it 2 ways: follow the money and follow the assets. And I think that's generally been the trend. So there was, and by money I mean capital, not just profits, but capital. Access to capital is very important. So, during the financial crisis, banks had sort of an existential moment where regulation plus capital constraints caused them to generally flee the business they had just entered over the previous 10 years. So the 2000s was the rise of investment banks as owners of assets, traders of assets. They shed those assets. They shed their profitability after a large clampdown in the regulatory space. So that led to the rise of trading houses that could manage the assets. And I think now, as the markets have gotten significantly more efficient and the U.S. crude grid has gotten significantly built out and has changed dramatically since 2016, I think now we're in another transition cycle into asset-backed trading. And that's reflected. Now, how do I know that? Not just observing it, but also seeing the data and who participates in the futures markets, what products they use. Those are trends that we can chat about as we go on here.
Yeah, so how is that participant landscape changing?
So if we talk about strictly from a trading perspective, so we look for where liquidity needs come from. So, when I started in the industry, everyone traded in trading pits. Obviously, that's all algorithmic market making now. I was, in the very manual space. So if you think about who's in the market, everyone's trading both the futures and options on trading screens that are facilitated by algorithmic market making. That's no secret. What we try to think about is who is the other half of the market. And in the other half of the market, the vast majority, well, not the vast majority, but the largest percentage by a long shot are physical trading shops, physical commercial participants in the market. They are more than half of what's left. If you think about it as a 50-50 split, we focus on the 50% that is what we call paper. And that breaks down among commercials, hedge funds, and then asset managers, ETF providers, and everyone else. More than half of that are still physical traders in the industry. Not just that. What are we seeing very recently is that hedge funds, which are you've probably seen a ton of headlines about them over the past year, they actually haven't grown in crude oil trading. They're about flat to what they were previously. What's truly grown are commercial players, U.S.-based commercial players, European commercial players that are involved in the physical trade of crude, doing a couple of things. One, trading much more around their assets and trying to optimize. These are challenging times in the market. 10-year lows in volatility, not really a huge price move. So what that leaves is that the industry has to optimize to continue to make profits and wring every penny out of their assets. That just leads to more trading by large commercial industry and bringing new players that are being challenged by international majors. And with the restructuring of the U.S. grid, they have to trade more to optimize their assets. And that's generally how it's played out.
Yeah, I mean, we're seeing exactly the same thing. I think that, so if you go back to the mid last decade, really dominated by these mega trading houses, and 2 of which have certainly converted themselves into mini oil majors at this point. But you've seen, just talk hedge funds for a second, it's absolutely true that since the high volatility starting, let's say 2019, 2018, and exacerbated by COVID, by other events, Russia's invasion of Ukraine, lots of hedge funds follow the money, right? Their investors have asked them, what is your plan re commodities? We've seen outsized returns by a couple of very public funds that have done very well in commodities. So the multi-strat hedge funds have come into commodities. Often that's been in gas and power. That's been other commodities that they've been really building out in. And we'll talk, I guess, in a moment about what that trajectory looks like. if we're not going to see sustained volatility, and last year heralded what's going to come in the next couple of years, I don't think it does. I mentioned earlier that we sort of ended the last decade with very few oil majors, producers, even on the retail side, having any kind of value chain optimization capability, to today where I would argue that pretty much every single, and this is around the world, producer, miner, refiner, retailer of fuels, a major is on some spectrum of developing asset-backed trading, and that's on the spectrum from kind of, optimization all the way through to pretty aggressive third-party trading. And I think that's driven by the need to capture more margin as markets have stabilized and become more efficient, but also seeing the outsized returns of the trading houses. And it's there was certainly a reaction during COVID in those first couple of quarters when other majors were looking at the results of BP and Shell, for example, who had outsized trading returns, as we need to get some of this. But I think it's also fundamentally driven by digitization. I think the barriers to entry on some of the platform pieces, the ability for you to monetize the data your system produces, has become much more available, much more tangible in the wake of technology. I think it's driven by the energy transition, decarbonization. There's so much volatility out there in terms of policy and technology that these firms are trying to get closer to their customers. If you're selling whatever it might be, fuel oil, can you also sell the steel? Can you, what's your client doing around batteries? And we're seeing different trading groups trying to cross-pollinate from energy into metals, et cetera, et cetera. And then I think, finally it's deglobalization. The events this weekend is a pretty volatile world. And these organizations need to have better responsive platforms to be able to manage that. And so even if your goal is not to make more margin, more sense in the bottom line, you absolutely need to have that kind of risk management capability in place. That, has put tremendous demands on the talent pool out there, which, no one was particularly growing new leadership, new teams. Teams were shrinking in the last decade. So one of the challenges all these organizations face is how do you bring in those capabilities and capacities from a human perspective, given the paucity of the talent landscape out there.
So these companies, these commercial market participants who are building out asset-backed trading operations, I think you're seeing that, Paul and Pete, you're saying that you're seeing a growth in commercial participants in the contracts that you oversee. Are these the same companies that we're talking about most likely?
Absolutely. I think U.S.-based companies have been the leader over the past, let's call it 2 years, that we've seen it. So there are a couple of things have happened over the past 5 years. European players have more and more exposure to U.S. molecules, whether it be crude oil or natural gas. That's factual, right? It happens with the export market. If you take the molecules, you take exposure to the market dynamics from that region. So that has driven the growth of, for instance, WTI trading, RBOB, gasoline trading, heating oil trading in international markets. But that's the high level, right? So now, for instance, in our WTI market, 30% of our volume is generated internationally. That's from low single digits 10 years ago. That's just the way this market has played out, right? So U.S. trading has become a global market. It's also changed the way the U.S. players have to position themselves to be competitive in this market because they were ceding a lot of margin, a lot of profits to companies that were more optimized for global trading, and now they have to catch up and make sure that they're capturing a lot of that pie onto their bottom line. So that's what's driven sort of the corporate build out, which is healthy for the industry, right? We think the more corporate players that are involved in the markets, the better it is. They're not just price takers, they're actually participating in price discovery and making investment decisions. Second thing is, just to touch on hedge funds really briefly again, the number of hedge funds in our market is more than 400, but that actually shrunk 9% last year. But that doesn't mean the capital went down. It just means that it's getting concentrated in fewer hands because they are the market forces everyone to be efficient and concentrate capital where it can be deployed. Now, and Paul mentioned that it was natural gas and power trading that took the bulk of that, and that's true. for sure, because that industry, and that's my home market, was undercapitalized for many years, didn't have enough investment capital. We haven't built a storage facility in 20 years. Now, the curve hasn't really supported that, but that when you starve a market from investment capital, speculative capital that can be deployed, then when it comes back in, it has to find a way in. So that's one way that we've seen it play out. But in the commercial space, the other thing we've seen is how people trade. So traditionally, long-term hedging was popular, and it still is. But in general, we've seen a move towards the front end of the curve. The risks are really in the prompt. The industry has decided that they would prefer to manage their price exposure with production up and down. Now, that's a more global thought process. Rather than just lock up a bank loan, hedge it, and move on with your life. I mean, I think the industry is a lot more dynamic with the export window opening and closing, huge investments that have to be made to change the grid in the U.S. We're seeing a lot of hedging in the short term. That also is reflective of asset-based optimization. Asset-based optimization is almost by definition in the shorter end of the curve. We've seen that in the rise of options trading. We've seen that in the rise of Gulf Coast basis trading, which is now the third largest market on our crude market. It's like we look at open interest, like how many open contracts are there? In the Argus assessments that we have in the Gulf Coast, it's over 700,000 total open interest. That's a large number, considering the major benchmarks are about 2 million open interest.
The energy and resources sector is experiencing unprecedented change. To help companies navigate this world and capture its opportunities, HC Group launched Enco Insights in 2023. Enco has rapidly become the leading global expert network dedicated to energy and resources. Enco Insights leverages HC Group's 20 years of connections and dedication to the sector to give clients the expertise they need to take decisions fast. Connect with Enco's experts for anything from a 1-hour insight call to a longer-term consulting project at encoinsights.com.
So it's a dynamic market where people are hedging, and they're hedging, if you're hedging a 30-cent margin, that's a lot, right? When you talk about the sheer volume that's happening in the market now, the margins are squeezing, they have to be hedged, and they have the tools to do that. And that's all commercial-based, asset-based trading.
So should we think at a high level about, commercial participants moving or sort of replacing long-term hedges, which might lock in price or margin with, more proactive day-to-day asset-backed optimization? Is that is it a sort of one or the other?
Answer some of that. I mean, I think some of that, I'm a recruiter, but some of that is driven by the much more transparency, granularity of contracts that sort of, lots of the physical stuff is hedged out. One thing I would say is absolutely this has been driven from the US, but simultaneously at the same time, IOCs, but NOCs as well, particularly I've just come back from the Middle East, those organizations, ADNOC, for example, has been so at the front of this, have been building these capabilities as well. And I think that you're going to see as US producers, refiners start to expand globally, their trading capabilities and reach. Also, we're going to see those NOCs come this way as well. So it is very much a global trend. The only other thing I'd say as well is if you sort of overlap these, so we've had the trading houses, they've grown. You're now adding all these asset-backed traders, which is significant. Then you add in the hedge funds. So that in the middle of that Venn diagram sits derivatives traders, financial traders who have deep physical backgrounds and knowledge bases, so that they're bringing with them that deep understanding of the industry to be able to deploy capital or manage these books. And that's somewhat new in the fact that 10 years ago there wasn't much demand for derivatives traders. So again, I sort of come back to there's sort of a confluence of drivers here that means I think A, this is going to stay, but B is really taxing quite a small community of capabilities to deliver this.
Yeah, I mean, my observation, kind of the joke, is that a game of musical chairs is broken out in Houston, Geneva, and London with in the trading world over the past 2 years.
Yeah.
But it is true. One of our fastest growing areas, of course, is also the Middle East. So they are trading much more actively. That term placements to Asian customers is still the main way of doing business. But there is a very active trading arm being developed across the NOC world and across the majors or the mid-majors in the U.S. that has definitely driven that. But when we think about long-term hedging versus positional asset-backed trading, a lot of it's balance sheet as well. The balance sheets in the industry are very healthy, and they weren't healthy 10 years ago. And I think when you're under capital constraints versus looking to deploy capital, that changes the mindset dramatically. Although you do still have a lot of asset service and debt service that has to be done on assets, and then you just need to optimize them. So that's driven a lot of the increased short-term trading as well.
Yeah, I mean, so speaking of balance sheets and, building out these trading platforms or commercial capabilities, we've, I think, historically thought of that as being, quite a big barrier to entry. But I guess the standard kit looks very different now in terms of, what the standard trading setup looks like. How are you seeing these platforms look, and is there really a lower barrier to entry?
So I think it's a tale of two halves in some sense. One is most of these asset-backed organizations, these aren't 1 or 2 year plans, right? These are 5, 10-year strategies. They're very well thought out. Often they're led by leaders who have long backgrounds in whatever commodity it might be, but in and around trading and supply optimization and so forth. So, I think to some extent, irrespective of the barriers to entry, they'd still be doing this for key strategic reasons. In terms of barriers to entry, so there's been a lot of platform and technological change that's happened in the last 10 years that mean paradoxically, in one sense, it's quite expensive to build out these CTRMs and so forth, but prices are going lower. But on the flip side, new technologies mean that it's far easier for these asset-backed organizations to understand and convert commercially the data that sits around their contracts, around their asset footprints, so that they're much, they see that as a great competitive advantage they have over a trader out of the hedge fund or wherever it might be. I'd say that actually we're not, we're sort of talking traders here, but there's an entire sort of aircraft carrier built around the trader as pilot in terms of compliance, risk, governmental relation, that whole world. We are an increasingly complex world. The risks are much higher than they were 10 years ago when it was, how much, where do you want it delivered and what's the price, to now where's it come from, what route did it take, what ship was it on. So there's a lot of other requirements in terms of people and capabilities that are now needed that perhaps weren't. I'd still say the biggest barrier to entry is actually internal. It's the commitment of leadership to actually build these capabilities out over the long term and how familiar they are with trading. And secondly, obviously, is getting the right leadership and people in place who can, frankly, train and build an organization, because you can't just rely on external hires anymore.
From an exchange perspective, and we've seen this evolve over years, we're 20 years into trading on screens. That's not new. But the democratization of access to markets is not just about trading, like, for instance, a single benchmark on screen. It's also the entire options market, which used to be very opaque, hard to understand. Valuations were hard to get. Voice brokers, daily runs, those are all available at the flick of a switch now to everybody. The software packages, pre, post-trade analytics are available to everybody. So, there is, if there's a will, if there's the capital, if there's the knowledge and the desire to do it, the tools are there. For instance, we see, and people can now get more comfortable with those products, like options, for example. So when I talk about hedge funds not growing, that's true in the futures market. They didn't grow. They were about flat on the year in crude oil. The commercial industry up about 12%. So it's when you talk about a couple of million contracts, and that's a lot. they've all grown. But they've moved to like the short end. They're comfortable doing that now. So we have options, like weekly options. You can trade an option every day of the week. That's a trend that has developed across the entire financial world, but it's come to commodities a little later. But it's, products developed. Like we launched an Argus product last year on balance of the month in the Gulf Coast. And people started to use that to manage their cargoes, which really was unavailable previously. So I think, but now they have the price transparency on things like intra-month crude pricing, which just was unavailable on a wide scale previously. So as you bring these products to market, as they get liquidity, as the cost, access, ease of use, data storage, data is another thing that has increased dramatically in democratization. It was really hard to find accurate fundamental information to do trades on, not just charting and things like that anyone has had for years, but true access to physical pricing across many different regions, updated in real time. Those are all things that have evolved over the past 5 years.
Which gets those organizations much more comfortable with the risks, right, as they're building out these capabilities.
Absolutely. There were whole teams when I started in the industry that would spend their whole time trying to figure out what one basis point might have traded at over the past week. Now it's in real time flashing on a screen. So, and you can see the liquidity there and you can see the volume. So it just makes, life a lot easier to get comfortable with that. And then that allows then a lot of comfort in managing assets, which are tied sometimes from, secondary benchmarks or basis locations off of the big benchmarks. So that's driven a lot of innovation.
So Paul mentioned earlier, the world's become very complex and the risks have become very different. And we heard from Ambassador Burns this morning about, a very scary world, and we're going to hear more of that. I guess, Pete, from the perspective of an exchange, what is the nature of the current sort of geopolitical risks facing the major oil benchmarks, and how are market participants confronting this?
Yeah, so the rise of exchanges and cleared markets versus over-the-counter markets was really driven by credit exposures. There were blow-ups in the early 2000s in the natural gas world. There were, banks that had a big challenge during the financial crisis. So, people are much more comfortable with central clearinghouses generally, and the market has almost wholly transitioned to centrally cleared markets. Now, when we talk about short-term geopolitical, there is the comfort level from a credit perspective, like everyone's going to be kept whole from a trading perspective on exchanges, on all exchanges globally. But there is a heightened concern and interest about what's going to happen geopolitically, right? That's driving volatility, which last year was at 10-year lows. 10-year lows in crude oil. It barely, from a trader perspective, you would say it barely moved. It was very range bound. But that drives a lot of concern this year on spreads, on concerns about what's going to happen with Canadian crude. The crude's going to flow. The question is, what disruption happens to the pricing? And I think that's where people are a little worried or concerned. And I think the sort of volatility of the policies themselves, I think, is generating a lot of debate. So I'll give you an example, but people flock right to the market. So in January, our volume in crude oil was up 46% or something. So again, everyone comes in to make sure they're hedged and managed. And I think that, the idea that you can, lay off your risk for short term, just let me wait till this all blows over type of thought process, or I don't want to get out of my portfolio. I just want to make sure it's hedged throughout this period of uncertainty. I think that's what's driving a lot of trading, a lot of volume. Now that, there's speculation on that, but the tools have developed over the last 5 years to be able to manage that type of event very well.
Yeah, absolutely right. I think it overall reinforces the need to have that kind of trading capability and lens on the market and the risk management capabilities. I think, more fundamentally, there is a bit of a worry that, if you look at the European energy crisis, that was solved by traders, right? I mean, the spice flowed because there was this free and open trading market from a physical standpoint. As this world gets more shaped by trade wars and, there's more and more government intervention, I don't want to get political, but that itself starts to break down some of the the fundamentals of how these markets work. There's also, again, you see the rise in the UAE that sort of very much stamped itself as we should be the center of energy trading. We're the right time zone. We've got, we're stepping out of some of the geopolitical trade wars. And one point I would suggest is that whereas Americans and the US has certainly been central to global energy trading, the launch of it and the development of it over the last 30 years, there aren't many Americans in the UAE because of tax policy and the rest of it, right? So I just think I think that we are going to see continued volatility, the absolute need to have trading and optimization capabilities. My sort of worry is that, there's a tipping point potentially where it starts to get so volatile and it stops the investment, it stops the trust and confidence in some of these markets and so on.
Well, traders like certainty, right? There's so many different variables you have to manage when you're managing a book. At least you want your, framework on what you're going to trade to be stable. And, there's some great things that have recently happened, right? Like getting the LNG facilities back on track as one example. And allowing, I think, generally, when you think about free trade, or call it unrestrained trade, you just want the industry to be able to respond in a timely fashion to price signals. And that's like basically the whole purpose of markets. It's what futures markets are out there to do: set a price signal, transparency, price discovery, and then allow the industry to adapt and adjust and supply the molecules where they're needed. And I think, and that's generally the positive trend. The rest of it, we'll have to see where it all ends up.
Well, so speaking about where it all ends up, I think you both have really nicely described the rise of asset-backed trading and, the strategies that different companies are deploying. So is this here to stay, or is it more of a passing fad?
I mean, there is this sort of a slight worry out there that this is, 2008 to 2014, where we saw big run-up in energy prices, lots of volatility, few events, lots of organizations getting into commodity trading, whatever commodity that might have been. And then suddenly, it flatlines, prices are low volatility, everyone gets out. And there, last year there were some signals of that, and one wonders how some of the hedge funds that have invested so heavily have fared. But I think, certainly talking to our clients in their boardrooms, there are 5-10-year strategies that are driven by those key drivers of the decarbonization, deglobalization, digitization, that kind of mean, I think, come what may, we're going back to a period of more organizations having trading capabilities, using the contracts and the technologies that are available to better protect themselves, gain more margin, and I think there'll just be some years more volatile than others. I mean, but I don't see us going backwards. I think this trend is here to stay.
I was at Lehman Brothers in 08. I try not to broadcast that too much, but in early 08, I was sitting at my desk trading natural gas at Lehman, and there was a line of mortgage traders looking for jobs on the commodities desk. And so I do think it's a cyclical market, and but what I'm positive about now and why I think it might be here to stay is because these are the real money players. These are players with a lot of physical stakes in the industry. They're motivated to grow the industry, and they're really like optimizing their own assets, making sure that they're resilient through cycles, and I think that's a positive sign for the market.
Yeah. Doesn't mean, as you said, it's quite a volatile industry to be a professional in, but I think that, I think those asset-backed traders are going to continue to be there, and I think that over time, we're going to see more of them going to go up that curve, I'll do it this way, from kind of just pure optimization all the way up to very much more sophisticated trading capabilities. And I think a lot of that is the energy transition. You have to get closer to your customer to understand what their needs are. There's technological volatility, all the rest of it. So, I think there will be good years and bad years, but I'm sure that we won't go back to sort of the doldrums of 2015.
Well, we'll find out.
Thank you.
Pete, Paul, thank you so much. Please join me in thanking Peter and Paul.
Thank you for listening. To find out more about HC Group, our global offices, and our expertise in search within the commodities sector, please visit www.hcgroup.global.